So the plan was originally to do these portfolio updates once a month, but this one's come early. And that's because a whole lot of stuff has happened. We've got 1. What is probably my biggest trade for the whole financial year. 2. Some major movers in the new portfolio. 3. Multiple weeks of declines for the S&P. 4. Several dividend payouts hitting the account. Or, well, actually, I thought they were going to hit the account, but they're not showing up on the graphs because they're in the mail, apparently. 5. Doing this update early means that I can now sync up the portfolio updates with the first of each month, which will make record keeping easier. And 6. I get to show off some snazzy new graphs. I mentioned I was a software engineer, right? Before I was too sick to hold down a job? Well, a few days ago, I spent the morning making a script that would take the exports from my broker's platform and turn them into cool graphs automatically. This will save me at least an hour of fucking around with Google Sheets for every video I make, and since I've only spent 4 hours on it so far, it's going to pay for itself by the 4th video, if not sooner, considering how much higher quality the graphs actually are. Look at this! The bars are on top of the other bars! Aha, not so fast though. We'll get to the gains in a bit. If the channel lasts, I'll start adding to the script's capabilities bit by bit to make more and sweeter charts as the series continues, but I think what it does now is a good base to start with. Onto the portfolio. So you know how last episode I said, I'm not going to lose any sleep over Allchem as long as it stays over $11. Well, it turns out that was a fucking lie. I have a philosophy when it comes to investing, one that I really believe in. That philosophy is, you should own the amount of a stock that makes you comfortable whether the stock goes up or down. If you're cheering for it to go up, then you're in too deep. If you're cheering for it to go down, then you're not in deep enough. And I was cheering for the price to go up. And the constant red of it getting blown the fuck out over the last 3 months had really started to wear me down, and that's how I knew I had made a mistake by continuing to hold. I kind of gave myself away in the start of the last episode, where when I started talking about AKE, one of the first things that came out of my mouth was, I want to own less. If you want to own less of something, there's an easy way to own less at literally any time. Just push the sell button. I wanted to own less. I had very good reasons to want to own less. And yet I wasn't selling. Why? I had a reason, but it was a bad reason. I wasn't selling Allchem even though I wanted to own less because I was hunting premium. That is, I wanted to collect that little bit of guaranteed money I was getting for selling my covered calls, i.e. letting somebody else decide when I had to sell. There's a name for this. It's called picking up pennies in front of a steamroller. Yes, I was making good money selling covered calls, but it wasn't enough to cover the losses from the stock's decline over the same period. I was forgetting the number one rule of selling covered calls. Anytime somebody asks me, what is a good stock for selling covered calls? My answer is always exactly the same. A good stock for selling covered calls is a stock that you think will do well and you want to own. That's it. That's the only stock you should be selling covered calls on. Notice how it doesn't say a good stock for selling covered calls on is one that you think will trade sideways for 12 months, want to own less of, and upholding purely for tax reasons. I think a part of this is I recently switched brokers to gain options access, and so the world of these strategies had literally only just opened up to me. I was like a kid on Christmas Day. Options were fun and exciting, and I wanted to try them out. But I was so excited to try out these new strategies that I broke a bunch of my own investing rules in the process. At the same time that I realized my mistake, I was watching a bunch of my new portfolio stocks mooning and thinking about how much better that money would be serving me if it was in one of the companies that I was truly optimistic about holding. So in the end, I made the painful decision to sell the full amount of Allchem that I was willing to sell this financial year, reducing my holding by a bit under $60,000. Failing to do this earlier was a very expensive mistake on my part. Considering how much Allchem has fallen from its June highs, this sale really hurt. But there's 2 things I'm trying to keep in mind. 1, sure it feels bad to miss out on the profit I could have had if I had sold 3 months ago, but to put things in perspective, this sale is a realization of $40,000 or 240% capital gain. So, as much as I've been beating myself up for the fact that it could have been $60,000, you can't go broke lucky in profits, and now I'm not so ridiculously overcapitalized. The second thing that I'm trying to keep in mind is why being overcapitalized is so bad and why it's so important to avoid. Which is that if the price goes down, you can't take advantage of that by increasing your holdings. This most recent sale has brought my Allkem holding down to $30,000 at the time of sale, which is still a decent exposure, but it's now small enough that if the price falls down to $10, I could take advantage of that by buying more on the cheap. That is not something that I could have said 3 weeks ago, and it's something that I fully intend to do. Regardless of whether I buy more or not though, I'm still not going to include it in the new portfolio tracking until I've realized all the outstanding capital gains on it. I wanted to start with a clean slate when I started tracking the new portfolio, and importing a 240% gain from a stock I bought 4 years ago doesn't feel in the spirit of the challenge. I don't want to be a one-hit wonder, I want to generate consistent returns. However, if I fully liquidate all of my Allkem next year and finish realizing the remaining capital gains, that puts the company back on the board to be potentially included in the new portfolio in future. Also, now the $60,000 that's been freed up can be put to work in the new portfolio. Before, many of my holdings in the new portfolio were ridiculously small. I quantify ridiculously small as anything less than like 5% of the total portfolio value. Before selling Allkem, there were 3 different stocks in this situation: Hum, BFL, and BIS. All 3 of these stocks were picks I liked more than Allkem, some of them a lot more, and yet I had so little money invested in them that all 3 of them could have doubled at once and it still would have made very little difference to my actual portfolio value. Now with the funds freed up from downsizing Allkem, I've been able to bring all of them up to a much more respectable holding size. I've scattershot the money across all the smallest holdings in the portfolio, plus 1 new ticker and some more CAA. I wasn't even planning to add any more tickers because I haven't even explained most of the ones I already own yet, but since nothing has really dipped that much, I had to find somewhere to put the money that wouldn't overcapitalize me. So I looked for a little bit and I came across Big River Industries, which seems like a very healthy firm in the business of supplying building materials. The last 20k I am holding in cash for now, ready to increase my holdings of anything that sees a major dip. With so many tickers in the portfolio, something's got to dip eventually, especially with an Australian recession likely on the horizon. But my threshold for buying a dip is a decline of at least 10% since my last purchase. You don't want to go in too hard too early when you're buying a dip, or else when one of your stocks sees a persistent decline, you'll have your entire portfolio stuck in there before it's even dropped 20%. That's how ordinary investors become bag holders. Don't become a bag holder. Anyway, since the last video, it's been a rough couple weeks for the S&P. The Vanguard Australian Stocks ETF is my benchmark, which tracks the ASX 300 index, not the whole market, as I mistakenly said last video. And that benchmark is down 2.3% since the first video, meaning that including dividends, it has provided a negative return for the first quarter to the tune of -1%. Meanwhile, ignoring the snafu with Allkem and the old portfolio, the new portfolio has been crushing. CAA is still the golden child, just making consistent, insane returns as the buyback forces the market price to converge closer to true value. My only regret with CAA is not buying more when it was trading below $8, but it was already my biggest holding by far, and I didn't feel undercapitalized at the time. Even though I knew it was the best investment, there was no way I could have predicted it would shoot up so fast. You've just got to have your money spread out so that you can rotate between the different stocks when things like this happen and their fortunes diverge. And normally my strategy for handling a big winner is to reduce my holding as it gets closer to my target price. This lets me lock in some gains and reduce my exposure in case of a reversal. However, CAA is actually nowhere near my target price. I consider fair value for this company to be over $12 per share, so until we break the $11 mark, I am not selling a single share, and I actually just bought another 10k at $9. I don't normally make a habit of averaging up, especially not 20% up. Every time I average up, I have to make a will save or I take 2d10 psychic damage. But this company really is something special, and it could be years before I find another opportunity like this. I know that I'll regret it if I miss out on a bunch of gains just because I didn't want to average up, and I really don't see this trading below $9 next year. Another good reason not to sell is that with the Allkem sale, I have realized enough capital gains this year to be paying tax, even after the 50% CGT discount. And considering I already have $8,400 of unrealized gains on this position, holding it for 12 months to get the capital gains tax discount and also move the realization of the gains into the next financial year is definitely my best play here, and will save me at least $1,000 in tax, more if it continues to climb. And climb is something another 10 months of holding will hopefully give it the opportunity to do. But the real news this week is CRN, Coronado Global Resources. Like I mentioned in the last video, this company produces metallurgical coal, also known as coking coal, which is used in steelmaking. It might seem weird to bet on a steelmaking ingredient right when China's property sector is melting down, and it kind of is, honestly. I've been avoiding iron ore producers for that exact reason, but when you actually dig into the financials of CRN, you discover that their margins are very strong, to the point where we could see a 20% decline in the met coal price, and they would still be turning quite a healthy profit. So when I bought this company, I was not banking on the met coal price going up. In fact, I thought it would either trade sideways or maybe even see minor declines over the next year, and I bought in anyway, because after a minor decline in the coal price, this company would still be making very good money for the price I paid for them. The second reason I was optimistic about this company is because their Queensland mining operations have been seriously disrupted by rainfall in the past, something that might explain why they were trading for such a low multiple. But this year is expected to be a double whammy low rainfall event for Australia, with an El Niño and an Indian Ocean dipole event in the same year. Long story short, if anything, Queensland is likely to have a drought this year, which means that Coronado's Queensland mine should be operating at peak capacity for pretty much the entire year. So that's what my reasoning was behind the purchase, and I do think that reasoning was sound. I think it was a good buy. But regardless of whether something is a good buy, sometimes you just get lucky. And this time, we got very lucky. Coking coal hasn't traded sideways. It hasn't seen a minor decline. It has fucking skyrocketed. Futures prices are up over 20% all across the board, which means this quarter they will have been printing money, and this will likely continue into the next quarter as well. At current coal prices, my target for this one is about $2.10 per share, which would have been a 30% gain from my entry price. As much as I would like to hold this one into next year for the capital gains tax break, I am much more nervous about this position than I am about my CAA gains, which I plan to diamond hands. CRN might give up a lot of these gains if the met coal price sees a sudden reversal, which, given all the bad news out of China, is not an unlikely scenario either. My original target price for selling this stock was $2.10, but yesterday there was a big drop in Chinese steel futures and it got me spooked, so I unloaded 2/3 of my holding at an average $1.98 per share, or a 25% gain on my entry price. The last $10,000 worth of shares, I may hold to $2.10 and beyond if there's no more bad news, but now that it's so close to my target price, I'm really glad I've reduced my holdings. If all the stars aligned, it might be possible to squeeze another 15% out of this stock, but I just don't want to be all that exposed to China's structural issues right now. Also, before we move on to the next stock, can we just take a moment to talk about this dividend? What the fuck is this? You can hardly even see it on the chart. There's a dividend there. 0.5 cent per share. That is like 0.2% of the share price. Why even bother with the dividend at that point? Who are you trying to impress with this? I'm so confused. I've literally never seen a dividend this small before. I've been at this like 15 years. Anyway, the rest of the holdings have been a lot less exciting. BIS has been down like the entire time since I bought it, but it seems to go green every time I'm about to take a screenshot for the channel, so I don't know what's going on there. I was literally looking at a big -8 for the last 3 weeks, and then the last day of the month comes around and boom, it's -3%, which when you add the 5% dividend that's coming in the mail is now at a +2% for that holding. Everything else is mostly in a holding pattern or slightly down, but not down enough to buy the dip. I'm still sitting on over 20k in cash waiting for an opportunity to buy something, but nothing being down is a good problem to have. Last of all, I bet you're wondering why Qantas is on here even though I don't own any Qantas shares, and that's because I've opened some short puts on them. Qantas have had an absolutely miserable month, down almost 20% in that time. I know it's a little weird to be taking a bullish position on an airline that's in the midst of a PR crisis when we have a potential recession on the horizon. Travel is cyclical after all, so people take a lot less holidays during recessions. But having looked at Qantas financials, I feel like the potential recession is now priced in after their recent massive declines. However, it's not fallen so low that I'm willing to catch the knife, so to speak, at the market price. So instead, I've opened $300 worth of short puts at the 490 strike. Let me break down what that actually means functionally for the portfolio, for those of you who aren't familiar with how options work. Essentially, I've taken on risk equivalent to owning $20,000 worth of Qantas shares, and my maximum profit is 1.5% of that. In this case, $300. Now, why would you take on $20,000 worth of risk in exchange for a 1.5% profit, when just buying shares would have the same risk and potentially unlimited upside? Well, the benefit of selling a short put is that I don't start losing money until the share price falls to my strike price. Whereas if I owned shares, I would start losing money if it went down even a cent. Right now, the price of Qantas shares is $5.18 and my strike price is $4.90. This means that Qantas can fall 5% over the next 3 weeks and I would still pocket my full 1.5% profit. It is not until the stock price falls below $4.90 that my risk starts to be realized. This is a good strategy for when you are bullish on a falling stock and you want to take a bullish position, but you're not 100% convinced it's bottomed out yet. Now, if we tally it all up and look at the scoreboard, we can see that we are absolutely flogging the ASX 300 ETF so far this financial year. In a bull market, anybody can beat the market just by having a large risk appetite and throwing darts. But in a month like this, where the benchmark is down 3%, making money on long positions when the benchmark is down is really the best indicator there is that you're on your way to beating the market for the year. What's more, our percentage return has been artificially reduced by the fact that I just injected $60,000 of cash into the portfolio in the last couple of days with the Allkem sale. Money which hasn't been invested in anything until a couple days ago and has had no chance to grow. If I hadn't injected that money from the Allkem sale, we would actually be looking at more than a 12% increase so far this financial year for the new portfolio, which is absolutely bonkers for a 3-month period. There is no way that I can keep up this pace of gains for the rest of the year, but we're off to a great start, and hopefully we can find some blue chip bargains over the next couple of weeks if the market keeps dropping like it has been. I hope you enjoyed the video. Please say hi in the comments, tell me what you think, and I'll catch you in the next video.